When we talk economics, what usually springs to mind? Probably demand, right?
Yeah, exactly. What consumers want, how much they're willing to pay. It's kind of the default.
But there's a whole other side to that coin, a concept just as fundamental, yet maybe less in the spotlight: supply.
Definitely. It's the engine that actually puts goods and services out there.
Without understanding supply, you're really missing half the story of how markets truly function.
Right. Demand might be the wish list, but supply is, the blueprint and the factory floor.
And that's what we're diving into today, the fascinating world of supply analysis. Our goal is to cut through the jargon, extract the most crucial insights about what supply really means, how it behaves, and maybe some surprising nuances.
And we're using a foundational economic text as our guide here.
Exactly. So consider this your express lane to being truly well-informed on this essential concept.
Sounds good. So let's start at the very beginning. At its core, supply is simply the total amount of a specific good or service available from a seller.
Available, okay, at any given price. Sounds straightforward. But I get the feeling there's more to it.
There is. There are a few related terms that often get a little muddled.
Right. Like when I think supply, I picture stuff on a shelf. But you're saying it's broader than that. Maybe you can help clarify the distinctions, like between, say, total output, stock, and supply itself.
Absolutely. Let's unpack that. Think of total output first. That's the grand total, the entire quantity of something produced by an economy in a certain period. The big picture number.
Okay, all of it. Like all the cars made in a year.
Exactly. Then we have stock. Now, stock is the total quantity a seller currently has on hand at a particular moment. It's their inventory.
So stock is what's actually in the warehouse or the back room.
Precisely. It's their potential supply. And here's the key bit. Stock normally exceeds what a seller is actively supplying to the market at any given moment.
Ah, okay, so they might have way more than they're trying to sell right now.
Right. For something perishable like milk or fish, stock and supply might be pretty close because you have to sell it fast.
Can't let it spoil. Makes sense.
So for durable goods, think furniture, clothes. A store might have a huge stock, but only a fraction is actually supplied, offered for sale at the current time and price.
So supply then is the active part, the quantity they're actually putting out there for sale.
Yes, that's the crucial distinction. Supply is a relative term. It's always linked to price, time, and quantity.
Okay.
Relative. It's the various quantities producers are offering for sale during a given period of time at a given price. It's what economists call a flow concept.
A flow.
Yeah.
Like it's moving onto the market over time.
Exactly. Think of it like this. Our source gives a great example. A farmer might have 4,000 kilograms of rice. That's their total output, their stock.
Okay, the whole harvest.
But if the market price is, say, 40 rupees per kilogram, maybe he only offers 1,000 kilograms for sale right now. That 1,000 kilograms is the actual supply at that moment, at that price.
Right. Holding the rest back, maybe hoping for a better price later. That makes the difference between what's available in total and what's offered right now really clear.
Yeah. It's not just what you have, but what you're willing to part with at that price.
And Paul Samuelson, the big name in economics, he summed it up nicely, didn't he?
He did. Supply refers to the relation between market prices and the amount of goods that producers are willing to supply. Captures it perfectly.
So how do economists actually visualize this relationship between price and what's offered? They must have tools for it.
Oh, absolutely. They don't just, wave their hands. The first basic tool is the supply schedule.
A schedule. Like a timetable.
Sort of. It's essentially just a simple table. It shows how the quantity supplied changes as the price changes.
Okay.
For an individual supply schedule, we're just looking at one single producer. Imagine someone making widgets.
Okay, widgets.
If the price is low, say 10, maybe they only offer 100 widgets. But if the price jumps up to 50, suddenly they're motivated to offer 500 widgets.
Right. Higher price, more incentive, more supply, and vice versa.
Yeah.
It's a direct positive relationship.
Exactly. And you can take that table, those numbers, and plot them on a graph. That gives you the individual supply curve.
And that curve will always slope upwards, right, from left to right.
Correct. It visually confirms that direct link. Higher price, higher quantity supplied.
Makes sense. And we can scale this up from one producer to the whole market.
We can. That gives us the market supply schedule. It does the same thing, but adds up what all producers are willing to sell at each price.
So you just sum up everyone's individual schedules?
Pretty much. If seller A offers 500 kilograms at 50, and B offers 600, and C offers 700, You just add them up.
So the market supply at 50 is 1,800 kilograms.
Exactly. And naturally, the market supply curve, which graphs that schedule, also slopes upwards from left to right.
It's a powerful visual. Shows the whole market responding to price changes. The collective willingness to sell increases as prices climb. Okay, so price is clearly a major driver. We see that in the curves. But for producers, there's got to be more to the story than just the sticker price, right?
Oh, absolutely.
What other forces are really, pulling the strings behind the scenes, influencing how much actually gets supplied? This is where it gets really interesting, I think.
You're absolutely right. Price is key, but it's far from the only thing. Lots of other factors significantly impact supply. Let's tick through some.
Okay.
First, the state of technology. This is huge. When a new, more efficient way to produce something comes along.
Like a better machine or a new process?
Exactly. It typically lowers production costs. That means producers can often make more for the same amount of money or the same amount for less money. Either way, it tends to increase supply.
Makes sense. Like the impact of automation or something. What about the direct cost of production itself? Raw materials, labor.
Critical. If the price of inputs goes up, say labor gets more expensive, or raw materials cost more, or energy prices spike, then the cost of making each unit increases. This often squeezes profit margins and can force producers to decrease their supply because it's just more expensive to make stuff.
Yeah, you see that with fuel price hikes affecting shipping costs and everything else.
Definitely. And infrastructural facilities play a massive role too. Think roads, ports, reliable electricity, communication networks.
Right. If you can't get your goods out easily or you have constant power cuts.
It doesn't matter how much you could produce or what price you could get. Good infrastructure increases supply capacity. Bad infrastructure, shortages, breakdowns, they decrease it.
Okay. What about the government? Government policy?
Big influence. Favorable policies like, say, subsidies for green energy production or tax breaks for certain industries can encourage supply.
Yeah, and unfavorable ones.
Higher taxes, stricter regulations, import-export restrictions, those can discourage supply, make it harder or more expensive to produce and sell.
And for farmers, natural conditions must be paramount.
Oh, absolutely, especially for agriculture. A good monsoon, bumper crops, increased supply, a drought, a flood, a freeze, disaster for supply no matter the price.
You can't argue with the weather.
You really can't. Then there are future expectations about price. This is interesting.
How so?
If producers think prices are going to shoot up in the near future, maybe there's a predicted shortage or they expect demand to surge.
They might hold back.
Exactly. They might strategically withhold some of their current stock, reducing current supply, hoping to sell it later for a bigger profit. Playing the long game.
Clever. Or maybe risky.
Can be both. And then our source lumps together some other factors. It's a bit of a catch-all.
Like what?
Things like the general nature of the market itself, competition levels, the prices of other goods a producer could make instead.
Like shifting from making chairs to making tables, if tables suddenly become more profitable.
Precisely. Also, export and import policies, labor relations strikes or good relationships, and just the basic availability of factors of production like skilled labor or specific resources. They all play a part.
Wow. Okay, so it's a really complex web of factors influencing supply, not just price.
It really is. If lots of these factors turn favorable, you'll likely see supply increase. If they turn unfavorable, supply will probably shrink.
With all these different determinants, it makes sense that economists needed like a core principle, a basic rule for how supply usually behaves, which brings us to the law of supply.
Yes, a cornerstone concept. And it comes from Professor Alfred Marshall.
The big name again. From his 1890 book, Principles of Economics.
That's the one. He really formalized this fundamental relationship.
And the law itself is pretty straightforward, right?
Yeah.
Can you state it for us?
Sure. It says, other things being constant, higher the price of a commodity, more is the quantity supplied, and lower the price of a commodity, less is the quantity supplied.
Okay. So it nails down that direct relationship we keep seeing. Price up, supply up. Price down, supply down. But there's that big caveat.
The crucial phrase, other things being constant, or ceteris paribus, as economists love to say.
Right. All those other determinants we just talked about. They have to stay still for the law to work perfectly.
Exactly. The law assumes things like a constant cost of production. If input prices suddenly fall, a producer might supply more even if the selling price hasn't changed, which seems to break the rule.
And it also assumes a constant technique of production. No sudden inventions making things way cheaper or faster.
Correct. And no change in weather conditions, a huge assumption for farming. Also, no change in government policy, so taxes and regulations stay the same.
No change in transport cost. Prices of other goods remain constant, so producers don't switch.
And no future expectations driving sellers to hold back or rush sales.
It's quite a list of things that have to be perfectly stable,
Right.
which probably doesn't happen often in the real world.
Very rarely all at once. But the law describes the fundamental tendency. When these conditions do hold, or approximately hold, that upward-sloping supply curve we talked about is what you see. It confirms that core positive relationship between price and quantity supplied.
But because those other things don't always stay constant, we get exceptions, right?
Right.
Situations where the law of supply kind of bends or breaks.
Exactly. This is where things get really nuanced. These are the exceptions to the law of supply.
What's a classic example? You mentioned one earlier.
The supply of labor is the textbook case. It gives us what economists call the backward bending supply curve of labor.
Backward bending. How does that work?
Well, initially, as the wage rate, the price of labor goes up, people are usually willing to work more hours. More money, more work. Makes sense.
Standard law of supply applies.
Right. But only up to a certain point. If wages keep rising significantly, some workers might reach a level where they start to value leisure time more than earning even more money.
The I've made enough point.
Exactly. Our source gives an example. Maybe a wage goes from $200 to $300 an hour. The worker could earn more by working the same hours or more, but they might decide, you know what, I'm comfortable. I'd rather work fewer hours, maybe 6 instead of 7, and have more free time.
So even though the price wage went up, the quantity supplied, hours worked, actually went down. That directly contradicts the basic law.
Precisely. It shows human motivation isn't purely about maximizing income. Another big exception, agricultural goods.
Because of the weather and seasons we discussed.
Right. Production is seasonal, depends heavily on weather. If prices for, say, wheat are sky high, but the harvest was terrible due to drought, you just can't increase supply. Nature limits it.
Okay. What else?
There's the situation of an urgent need for cash. A seller might be in a financial bind, desperate for funds now.
So they might sell off their stock cheap.
Yeah, they might sell products below the prevailing market price just to get money quickly. Supply increases even as price drops or stays high despite a low price. Again, breaking the pattern.
That makes sense in a tough spot.
And similarly, think about perishable goods. Vegetables, fruit, fish, eggs.
Things that go bad quickly.
Exactly. To avoid total loss from spoilage, suppliers will often sell more quantity even if they have to accept lower prices, especially as the goods get closer to expiring. It's about loss minimization, not profit maximization at that point.
Better to get something than nothing.
Right. And finally, a very clear exception. Rare goods. Think unique things.
Like a famous painting or a specific antique coin.
Perfect examples. Rare paintings, antique goods, one-of-a-kind collectibles. Their supply is essentially fixed. You can't make more of Da Vinci's Mona Lisa no matter how much someone is willing to pay.
So the supply curve is just vertical.
Exactly. Price changes, but quantity supply doesn't budge. It's completely inelastic because it's unique and can't be reproduced.
These exceptions really highlight that economics isn't always neat lines on a graph. Real life throws curveballs.
It certainly does.
Okay, this leads us to another really important distinction, one that sometimes trips people up. It's the difference between moving along a supply curve versus the whole curve shifting.
Yes. Differentiating between variations in supply and changes in supply. It sounds technical, but it's crucial for analysis.
So what's the difference? Let's start with variations.
Okay. Variations in supply happen only because the commodity's own price changes. And crucially, all those other factors, technology, costs, expectations, etc., are assumed to be constant.
So price changes, everything else stays the same.
Correct. And this causes a movement along the existing supply curve. We don't draw a new curve.
Right. So if the price goes up and the producer supplies more as a result,
That's called an expansion of supply. You move upward and to the right along the same curve. More quantity supplied at a higher price.
like deciding to run the factory an extra shift because prices are great.
Exactly. And if the price goes down and the producer cuts back production,
That's a contraction of supply.
you move downward and to the left along the same curve. Less quantity supplied at a lower price. Simple movement due to price.
Okay, that's variations. Movement along the curve caused by price. What about changes in supply?
Changes in supply are different. This is when the quantity supplied changes, even though the price stays the same.
How does that happen?
It happens because one or more of those other factors, the non-price determinants, has changed. Technology improved, input costs fell, government policy changed, weather was great.
So it's driven by something other than the product's current price.
Precisely. And when this happens, the entire supply curve shifts its position.
Okay, so if something favorable happens, like cheaper raw materials.
That would likely cause an increase in supply. The whole supply curve shifts to the right. This means producers are now willing to supply more goods than before at every single price level, including the original price.
More supply at the same price, a rightward shift.
Correct. And the opposite. If something unfavorable happens, say input costs skyrocket or there's a major factory strike,
then we get a decrease in supply.
Exactly. The entire supply curve shifts to the left. Producers are now willing to supply less than before at every given price. Less supply at the same price.
Okay, that distinction is really clear. Variation is movement along the curve due to price. Change is a shift of the whole curve due to other factors.
Got it. And understanding that helps you diagnose why supply is changing in the real world. Is it just a price response or something more fundamental shifting?
Okay, fantastic. We've covered the core ideas of supply, the visuals, the drivers, the law, the exceptions, and these movements versus shifts. But for any business, this all has to connect to the bottom line, right?
Absolutely. Theory meets reality on the balance sheet.
So how do these concepts translate into the practical decisions producers make about, well, costs and making money?
No.
Let's get into the cost and revenue concepts.
Right. This is where the rubber meets the road for a firm. Let's start with cost concepts. The most basic is total cost, TC.
That's everything spent to produce something.
Pretty much. The total expenditure on all the factors of production. And you can usually break TC down into two parts.
Okay.
Total fixed cost, TFC. These are costs that don't change with the amount you produce, at least in the short term. Think rent for the factory, payments on machinery. You pay those whether you make 10 units or 1,000.
Got it. Fixed costs. And the other part?
Total variable cost, TVC. These do change with production volume. Things like raw materials, hourly labor wages, electricity used in production. The more you make, the higher these costs go.
So total cost is just fixed cost plus variable cost. TC equals TFC plus TVC.
Exactly. Then from total cost, we can figure out average cost, AC.
Which is just the cost per unit.
Right. You take your total cost and divide it by the total quantity, TQ, produced. AC equals TC, TQ. Our source has an example. If total cost for 40 units is 800, the average cost is 840.
Which is 20 per unit, useful for seeing your average production expense.
It is. But often for making decisions about how much to produce, marginal cost MC is even more important.
Marginal, meaning the edge or the extra one.
Precisely. Marginal cost is the net addition to your total cost that comes from producing just one more unit of output.
Okay, the cost of making that next item.
Yes, the formula looks like MCN equals TCN, TCN1. So if producing 4 units costs 200 in total and producing 5 units costs 250.
Then the marginal cost of that 5th unit was 250 minus 200, which is 50.
Exactly. Producers think about this a lot. Is the cost of making one more unit going to be worth it?
Right, because that leads directly into the other side.
Yeah.
Revenue.
Exactly. Revenue concepts. This is the money coming in from selling the goods.
Starts with total revenue.
Yep. Simple one. It's your total sales income, price times quantity sold, TR, price X quantity. If you sell 15 units at 200 each.
Total revenue is 3,000. Easy enough.
Then similar to average cost, we have average revenue, AR. Revenue per unit sold.
So total revenue divided by total quantity.
No.
AR equals TRTQ.
Yeah.
Using your example, 3,000 divided by 15 units.
It gives you an average revenue of 200 per unit, which you'll notice is usually just the price you sold it at.
Right. AR generally equals price.
Correct. And then the counterpart to marginal cost, marginal revenue.
The extra revenue from selling one more unit.
You got it. The net addition to total revenue from selling one extra unit, MRN, equals TRN, TRN1.
So if selling 20 tables brought in 4,000 total and selling 21 tables brings in 4,200 total.
The marginal revenue of that 21st table is 4,200 minus 4,000, which is 200.
And producers compare that MR to the MC, the marginal cost.
That's often the key decision point. If the extra revenue from selling one more unit, MR, is greater than the extra cost of making it, MC, it generally makes sense to produce and sell that unit.
Makes perfect sense. That's the profit motives in action at the margin.
Exactly. Oh, and just a quick point of clarification. The supply we've been talking about today, focusing on individual firms and markets, that's a microeconomic concept.
Okay. Micro.
When you hear economists talk about aggregate supply, that's a macroeconomic concept. It refers to the total supply of all goods and services in the entire economy at different overall price levels. Different scale, related idea.
Got it. Good distinction. Wow, okay. That was definitely a deep dive into supply.
We covered a lot of ground.
We really did. We peeled back the layers, starting with the basic definition, making sure we distinguished it clearly from stock.
Then we looked at how economists visualize it with schedules and curves, both for individual producers and the whole market.
And then we dug into all those determinants beyond just price, technology, costs, infrastructure, policy, weather, expectations. Quite a list.
Which led us to the law of supply itself, that fundamental relationship articulated by Marshall.
But also the importance of its assumptions, the other things being constant part.
And then the fascinating exceptions. The backward-bending labor curve, agriculture, perishables, rare goods, where the simple law doesn't quite fit.
That was really interesting. And we untangled that crucial difference between variations just moving along the curve because the price changed.
And changes in supply, where the whole curve shifts because one of those other factors changed.
And finally, we connected it all back to the producer's wallet, looking at those essential cost and revenue concepts, especially the marginal ones.
Yeah, TCAC, MC on the cost side, TR, AR, MR on the revenue side. The tools businesses use.
So, wrapping this up, what does all this mean for you listening in? Why should you care about supply analysis?
Well, understanding supply helps you move beyond just thinking like a consumer. It gives you a much fuller perspective.
Right. You can better interpret economic news when you hear about supply chain issues or shifts in production costs or the impact of new technology.
You can analyze market trends more effectively. You start to appreciate the incredible, often hidden complexities behind getting goods and services onto the shelves and into your hands.
It really provides a more complete picture of how markets truly function, balancing out the usual focus on the demand side.
Definitely. And maybe here's a final thought to leave you with. We talked about the law of supply and how it depends on other things being constant. Given how many of those other things there are, technology, costs, weather, policy, expectations, how often do you think that ideal stable scenario actually holds true in our incredibly dynamic, interconnected world?
Probably not very often or not for very long.
Right. So what does that imply about our ability to perfectly predict real-world supply changes? And how does it challenge us, maybe, to think more holistically, more systemically about all the forces constantly shaping our economy?
That's a great question to ponder. Lots to think about there.